but particularly the precious metals, is one of the reasons we're holding these things is because the debt problem has become completely insurmountable. And at some point, we expect a currency collapse. It does not make any sense to be talking about what is gold worth in dollars if the dollar itself is not worth anything.
We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tim Price, director at Price Value Partners and the author of Investing Through the Looking Glass, a rational guide to irrational financial markets. Thanks for joining me today, Tim.
Thanks for having me, Tom.
Excellent to have you. And I spoke to one of the other directors at Price Value Partners a little bit in the past here, Killian Connolly. And, in prepping for that interview, I had read a bunch of your commentary. So I've been looking forward to this conversation for a while here.
You're clearly a glutton for punishment, Tom.
Well, that's the way that I like to do things, is to be able to research my guests before speaking to them. So that's my way of, in some ways, repaying you for your time and also just helping myself broaden my knowledge base in all of these different areas. But I'd like to start with the book, Tim, if you wouldn't mind.
Sure.
You wrote the book with the subtitle, A Rational Guide to Irrational Markets, in 2016. So considering what we have witnessed in the markets since 2016, and especially over the last 2 years, did you think that the markets could get this irrational?
It's a really good question, and the short answer is no. So the book kind of isn't really my idea. The book came about because the publishers, Harriman House here in London, just said, they phoned me out of the blue one day and just said, would I like to write a book about investing? And I'm basically a complete tart when it comes to communication and self-promotion. So after about a millisecond, I said, yeah, absolutely, I'd be delighted to do that. And I think they probably approached me in early 2016, and I think the book finally came out in probably October or so that year. And I was desperate for the thing to come out because I wanted to get it out before the market could correct in any meaningful way. The fact that we could be now here, what are we, 6 years on from that, and much of the insanity has only got even more insane, I find really quite extraordinary.
Yeah, and I think, where I'd like to go next here is a great example of that. And maybe we can highlight some of that insanity. So in the book, you make reference to the white queen in Alice Through the Looking Glass that says, we must now all believe as many as 6 impossible things before breakfast. So what are some of those impossible things that we must all believe at this point in time?
If I had to single out one, it would be the idea that the Federal Reserve in particular and central banks in general have any clue what they're doing.
As I've had a couple conversations this week already, Jesse Felder highlighted, he told me that the Fed is so far behind the curve, they can't even see it.
I think the Fed is so far behind the curve, it would have trouble continuing this metaphor. It's not even playing the same game. It's not just a different stadium. It's a different landmass. Mm-hmm. I mean, this is the incredible thing, that a lot of the book was driven by, I suppose, my experience is that I started my career as a bond salesman. And so the first 10 years of my career was spent in the debt markets. And I got a bit bored of that by the late 90s. So I moved into private client portfolio management. And even at the late 90s, it seemed to me that there was a fairly short shelf life for the debt system because yields were declining, et cetera, et cetera, et cetera. And yet here we are. And the trouble with the bond market is that it's a sort of red-headed stepchild of the financial markets. That the equity market gets all the kudos and all the attention and all the column inches and airtime. And the bond market behind the scenes is so much bigger. I mean, not just by value, not just by market capitalization value, but just it's a bigger story. It's a complete juggernaut of it. It's a beast. What happens with bonds will make a big difference to what happens to every other asset class on the planet. And I think people are, even now at this late stage, unaware of just how extraordinary things have become in the bond market. Interest rates have not been this low in all of recorded history. And the idea that, we were talking about this before we came on air, the idea that any central bank, much less the Fed, can now just effortlessly start to hike rates at a time when the entire financial world is conditional on rates not being any higher. You say this is Alice through the looking glass territory.
Mm-hmm. Yeah, it's so interesting to think about. And that's what I was going to ask you about is, when we think about the price of money or interest rates, the price to borrow some quantity of currency, believing that that is at zero or negative just seems completely counterintuitive in this environment, does it not?
It's like denying a core statute of Newtonian physics, like saying that gravity doesn't really work.
Mm-hmm.
It is so extraordinary to have interest rates at zero, let alone below them. I mean, that is just abhorrent to any person's way of thinking.
Mm-hmm.
We're touching on some quite sort of weighty things quite early, because if you start talking about interest rates and time preferences and moneyness and store of value and all this stuff, pretty soon you get onto what money is. And this, I think, would be the most intriguing thing that I've experienced in the 30 years I've worked in the financial markets, that I would humbly suggest that 95%, if not more, of the people that work in finance don't have a clue about what money is.
Mm-hmm. Personally, I like the distinction that Mike Maloney from Gold Silver points out, that money is a real store of value, like, for example, precious metals, and currency is what we, in some ways use every day. So do you think that that's a good distinction to make, is to call them two actually separate words, because inherently they have different defining characteristics?
So I think that the classical economic definition of money, it has three attributes. It's a unit of account. In other words, you can price stuff consistently in it. It's a medium of exchange. In other words, it's something that avoids barter. So it's a convenience good. And it's a store of value. In other words, it retains its value in real terms over time. I would defy anybody now to make a case for the monetary system that we currently use satisfactorily meeting any of those attributes. In other words, we've just debauched the currency or the money. We've debauched it to kingdom come.
Mm-hmm.
And so I suppose one thing that's informed our investment process over the last, really 2 decades, is I had the very great fortune to be running in or moving with, let's say, classical economic circles as far back as 2000. So I was rubbing shoulders with people typically based in Switzerland, to be fair. They would probably be self-styled Austrian school economists, but
Mm-hmm.
classical economist also works. And these are people who had thought very profoundly about what money really is and what it should be. And so at a time when other people probably were focusing purely on the first dot-com bubble back in 1999, 2000, I was hearing about these weird-sounding people like Ludwig von Mises.
Mm-hmm.
And for anyone that's unfamiliar with Mises, and I suspect, given your podcast, that probably many of your listeners will be very familiar with Mises. I mean, I'm not an economist by background. I read English at university, but Mises, as I would sum up the guy, one of the fathers of the so-called Austrian school, and someone who had first-hand experience of the Weimar era hyperinflation. And essentially, to sum up his sort of belief system, now I hope this isn't unfair, because I say I haven't studied this at a sort of a graduate level or anything. He believed in three things. He believed in sound money, he believed in small government, and he believed in the rights of the individual, so sort of broadly libertarian principles. And the tragedy of our time is that we don't have any of those things anymore.
Mm-hmm. I remember listening to I think it was a cryptocurrency focused podcast, and they talked about let's say the different ways that money or currency has influence over the way that people act. So, when we tie the idea of sound money and liberty to currency, from your perspective, Tim, do you think that can change behavior?
For sure. I mean, the one thing that's quite clear, and I worry consistently about what Mises called the crack-up boom. So the crack-up boom is this period where the penny finally drops for the man in the street. The value of his money is being eroded quite deliberately, quite consciously. I mean, one of the great Mises quotes is that inflation is not an act of God. Inflation is a policy. It's a policy that's consciously chosen by government/central banks. Because there is a tendency for government always to be in debt, there is a concomitant tendency for government always to want to inflate the value of that debt away. So effectively to default on it in real terms. Mm-hmm. And the problem, and this is something that probably suffuses the book, Investing Through the Looking Glass, is that having started out in the bond market, I feel like the bond market is kind of home territory. That's not that we invest in debt anymore. We find the bond market utterly uninvestable at current prices and current yields. So the bottom line, and I think debt and money are intrinsically linked. The issue is that there has been so much debt expansion over the last, really since Nixon took the dollar off gold in 71. The system can barely survive in its current form much longer. If you accept the argument that there is too much debt in the system, so it's clogging the arteries of global trade and global capital flows. If you accept that argument, then you also have to accept that there are only three and a maximum of three possible ways out of this predicament. Mm-hmm. The first way out is that governments manage to engineer enough economic growth so they can keep the debt serviced. I'd argue we're way past that point now. The second way out is that you default on it. Or if we're going to be more polite, you could call that a restructuring or a debt jubilee, but they amount to the same thing, mm-hmm. The repudiation of the debt in question. And the third way out happens to be, what's in box number 3 happens to be what's always been the preferred choice by government throughout all of history, which is you inflate the stuff away. Mm-hmm. It should not be any surprise to anybody, the current environment where we're seeing CPI prints of 5, 6, 7% or worse. And the idea that this is transitory is just complete nonsense. So this looks like it's going to be set in for some time to come. Mm-hmm. And it's probably going to be set in even more so because the Fed and other central banks have boxed themselves into a corner. There's a complete lack of credibility for all of these jokers. They can't cut rates, nor should they really want to, because they're already at zero or fast approaching it. And they can't raise rates, which is what the market probably desperately wants them to do, because that runs the risk of bringing down the entire, house of cards. Mm-hmm. So I've thought for most of my career that being head of a central bank is the job I wouldn't wish on my worst enemy. And it feels that way in spades now.
Mm-hmm. I pulled a quote from the book and it goes great in line with what we're saying here. It was a quote from Alan Greenspan. It is that we can guarantee cash benefits as far out and at whatever size you like.
We have a technology called the printing press.
Exactly. But we cannot guarantee their purchasing power. So that speaks directly to the inflationary nature of currency at this point.
And I can't believe he had the gall to even articulate those words. He's like he doesn't care being found out.
Well, that's another whole can of worms that we can go down. But, I've touched on incentives many times on the show. And when we think about the incentives for politicians to do the responsible thing, to do what isn't palatable, all of the incentives are completely contrary to actually doing the right thing.
The political class has only one interest, one alone, which is how do I get reelected?
Exactly. And, that can kind of go back to our point, talking about the way that the monetary system can kind of change and direct behavior in this environment, right?
So I think we were talking about the crack-up boom earlier. One thing that I think is going to be increasingly, if we're not indeed even in the early stages of a sort of Misesian crack-up boom now, is that as more and more people twig that the inflation beast has got out of its cage and is sort of prowling and running around rampant, people are going to want to start spending their money faster because they will, if they realize that the real value of their savings is being eroded, the last thing they're going to want to do is sit on it and keep it in cash. They're going to want to spend it as fast as possible. Mm-hmm. And that could then become a self-fulfilling prophecy.
So when you talk about the crack-up boom, Tim, the characteristics of that, it's not necessarily, let's say, a melt-up that some of the analysts talk about, but is it more so a hyperinflationary environment that you're trying to define by saying that?
It might not necessarily end with hyperinflation, but it can certainly be messily high inflation. So I still think that a fair historical analog to what we're now experiencing is the late 1970s. Mm-hmm. So I was a kid in the late 1970s, but I can remember some of it. And here in the UK, we had the famous winter of discontent that ultimately led to the election of Margaret Thatcher, who then changed everything sort of economically, domestically at least. So for sort of quick, I suppose for my own benefit, sort of reminder of what the sort of the edited highlights were of the 70s. You had two oil shocks. Well, first you had the Nixon gold shock, mm-hmm. which was a profound change in perception of currency. You then had two oil shocks. It was a decade of high inflation that morphed into stagflation. So in other words, high inflation, but without any economic growth to compensate you. And it ended with all kinds of social disunity, tensions with the unions, riots on the streets, this kind of stuff, dogs and cats living together. And it was just awful. And I think just anecdotally, if we're not there, we're fast approaching something that looks an awful lot similar.
Mm-hmm. Tim, I'd like to kind of go back to the idea about interest rates. So when we think about how, let's just contrast here for the example of the EU having negative interest rates and the US having zero interest rates. Is it impossible for the US to actually go nominally negative? Obviously not real negative rates, which are here already, but why is it that the US can't really go to nominal negative rates?
I think there'd be a civil war if that were to happen. I think, you would have the worst bun fight between members of the public and, let's just call it Wall Street, for want of a better phrase. It was only 2008 when Main Street bailed out Wall Street. And the idea that the same thing effectively has to happen again, I think would be quite rightly treated by people as completely morally abhorrent. So I think you can legitimately make a case for the reason we're in this situation now is because, and to be fair, this is something I start the book with, which is the story of the head of JP Morgan, Jamie Dimon, having a conference call with his board the weekend that Lehman Brothers failed. And I'm going to give you the specific quote. So we're talking 13th, 14th September 2008. At just past 7 a.m. on the Saturday morning, Jamie Dimon, the CEO of JP Morgan, America's largest bank, walked into his home library and dialed into a conference call with his management team. Here is what he told them. Quote, "You are about to experience the most unbelievable week in America ever, and we have to prepare for the absolutely worst case. Here's the drill. We need to prepare right now for Lehman Brothers filing, brackets for Chapter 11 bankruptcy protection, brackets, and for Merrill Lynch filing, and for AIG filing, and for Morgan Stanley filing, and potentially for Goldman Sachs filing." There was a collective gasp on the phone. And you go, well, hardly a surprise. So September '08 and the failure to save Lehman Brothers, whether Lehman Brothers was sort of cast to the wolves or not doesn't really matter anymore. Mm-hmm. Whether or not sort of old scores were being settled on Wall Street by the regulator. The issue is that quite clearly Wall Street came to a fork in the road. I should say the Fed came to a fork in the road. So the Fed could have taken the route of, no, let these fellows fail and we'll start again. The system can be purged. We'll start again. It'll be painful. It'll be, pronounced deflationary shock, but we'll purge the rottenness from the system. We'll start over. Mm-hmm. Is that what happened? No. What actually happened is basically Main Street wrote a gigantic check for Wall Street, which until the COVID nonsense came along was probably the biggest check ever written in American history. Mm-hmm. So the system could have reset back then. It would have been painful. I'm not disputing that, but I think we'd ultimately have been in a better place. But because the authorities lacked the moral bravery to act there, they and the politicians, as we just said, lacked the integrity and moral fiber to do the right thing. Instead, everybody got a bailout. And the result of that is we now are where we are, which is in an infinitely worse place. Mm-hmm. So rates came down and they reached basically ground zero, and they reached the so-called zero lower bound. Quite how Europe managed to get away with it and the ECB managed to get away with negative rates, God only knows. But maybe Europeans just have a higher tolerance for pain than Americans do. Mm-hmm. But either way, this nonsense has to change. So one thing I've learned from working with my colleague Killian is, Killian has studied sort of monetary, let's call it monetary regime change. And the reality is monetary systems change all the time. I mean, it may take decades for them to finally give up the ghost, but the idea that we should be afraid of a new monetary system is not necessarily the case. The reality is it's probably going to have to change anyway. This system looks like it's on borrowed time. And there is a critical lack of credibility just at those places where it's so desperately needed, mm-hmm. i.e. the central banks.
Yeah. And I think, transitioning to a new monetary system is something that I'd like to get to in this conversation. But, I'd like to touch on another seemingly very important time in history. You recently wrote commentary as though looking back over 2020 and 2021 as written in a history book. So you said that between September 2019 and March 2020, the Fed injected more than $9 trillion into the banking system, equivalent to more than 40% of US GDP. So does this point to the fact that there were much bigger problems in the repo market in September of 2019 than most understood at the time?
It would seem to, wouldn't it? I mean, the repo market is one of those highly technical things that unless you're basically working in the bond market, you'd probably, certainly I wasn't aware of it at the time. So it came as news to me when I found those statistics. But it would appear to be the case that we've just had a stealth 2008 bailout. And basically, there's been a blanket ban on reporting the stuff. So, talk about cancel culture. Now, to say the mainstream media has abjectly failed at its core job would be an understatement. Mm-hmm. But certainly something had gone very badly amiss, not just at one bank, but basically all of Wall Street in Q3, Q4 2019. I think historians will be digging through the pile of this for years.
Mm-hmm. So, Tim, when we think about, how we're going to, let's say, transition to a new monetary system, you and I were speaking before we hit record here about the fact that you're extremely risk averse. So what are some of the types of assets that you think are going to safeguard against, real pain when transitioning to whatever type of new monetary system we see develop?
The most honest answer I can give is basically just to describe what we're doing at the moment with our own money, with our client money. So this may well be something that Killian and you discussed a little while back, but essentially we break the world down into three types of asset. So first and foremost, there's, let's say, classic Benjamin Graham style value stocks. So shares in well-run listed businesses run by principled, shareholder-friendly entrepreneurs with a track record of outperformance in the stock market and a track record of superb capital allocation, where it's possible to buy those shares at a meaningful discount to their inherent value or their real net value. Why that discount can sometimes arise is anybody's guess, but suffice to say, no one ever said the market was rational apart from perhaps clueless economists. So classic value stocks would be the first port of call. The second port of call for us, a type of trading approach, a type of price momentum approach, which is known as systematic trend following. For anyone that's interested in more on this topic, a guy called Michael Cavell has a superb website called trendfollowing.com. And the trend following story is just trend following alone is something I could cheerfully bore for England about for days on end, because I find the whole story fascinating. But essentially, trend following funds are almost the exact opposite of value investors in that they don't even care about the price, except in as much as they want an uptrend in price to continue, or they want a downtrend in price to continue. So they don't even mind if the market's going down. They don't really have any emotion to the market at all. Mm-hmm. And so what a trend following fund does is it simply, I mean, most of the time it's not even invested. It's got its assets, its capital held as T-bills. But when their system, which will normally be some form of algorithm, when their system identifies a market that's trending strongly, whether that's higher or lower, they're completely neutral about. Let's say for the sake of argument, the corn price is going higher or the copper price is going higher. Their system will basically say, okay, let's go long a unit of corn at X dollars, and then put in a stop so that if the market turns, we're out of that position. But as long as the trend continues, put in another buy order at X plus whatever percent, and continue to pyramid into that for as long as the trend lasts. The beauty of this approach is that what most fund managers, I suspect, are guilty of basically, I feel lucky about corn, so I'm going to go long a bit, and then when it gives me my price objective, I'm going to take profits. Whereas the trend following fund doesn't even care about that. He just says, for as long as this market is trending, we're going to ride it, mm-hmm. or ride it until it stops. And particularly in the commodities sector, commodities prices can outperform people's wildest imaginings in price terms. So you can perfectly plausibly have a move of 100, 200, 500, even 1,000%, something that would be extremely unlikely most of the time in the stock market. Anyhow, so the typical trend following fund will have, because it's algorithmic based, it'll all be based on rules and probably a relatively small number of fixed rules from which that fund cannot deviate. So it has to be rigid in its discipline, which is why it's so difficult to pull this trick off in the real world. A given trend following fund might, for example, there might be long copper, there might be long wheat, there might be short German government bonds. They'll have investments long and short, or trades long or short in interest rates, currencies, hard commodities, soft commodities, the works. Because they're trading long and short, their net market exposure is basically zero. And because their net market exposure is basically zero, they have no correlation to the stock or bond market. So whatever their future returns are, we can say with a degree of confidence They're going to act as good diversifiers in a balanced portfolio. So that's the second type of thing that we invest into, which is basically a form of portfolio insurance. It's certainly a form of portfolio diversification. And then the third component part is what we call real assets. In other words, non-financial things, things that if you drop them on your foot, they hurt. And that right now will include things like precious metals companies, commodity related businesses with exactly the same kind of value attributes that we were talking about earlier. And those three types of assets together, value stocks, classic Ben Graham value stocks, plus trend followers, plus real assets, is the best way we've so far found to attempt to sort of navigate not just previous storms, but the storms to come. And that's a way of navigating by being more or less fully invested, but without having exposure to currency, because we don't want currency risk. Mm-hmm. And I think one thing you can certainly the conclusion I've come to is that if the authorities, as seems to me increasingly likely, do try and monkey around with price controls in the markets, maybe yield curve suppression, maybe yield suppression. So they may well peg a level, say, in the 10-year Treasury note and say here and no further. If they try and Mickey Mouse around with that, then the only thing that's left to the trading or speculator community to express an opinion is currency. And the currency market is, as I know from personal experience back as far as September 92, when sterling was ethnically cleansed from the European exchange rate mechanism, the precursor to the euro. The one thing that we know from that experience is that the one market that's too big for even the world's governments combined and the world central banks combined to control is foreign exchange. So my suspicion is that if they do try and muck around with markets, whether that be equity markets or bond markets in terms of price suppression or price controls, then the one thing that will ultimately happen is that the genie of the free markets will arise in the form of huge currency volatility. So in our world, not least in terms of the inflation we've been discussing, pretty much all roads lead back to precious metals one way or another.
Mm-hmm. So when you write about precious metals, Tim, you're saying in the book that you think that there is likely no other asset that is more misunderstood than gold. So does this still hold true today? And why is it that there is no other asset that is more misunderstood than gold?
I don't know. I think I'd still hold by that statement. I mean, maybe cryptocurrency is also misunderstood, not least by me. But I think it's that we operate, and certainly the US market is the sort of the biggest, most dominant market in the world for capital. The US economy is hyper-financialized. The Western economies are hyper-financialized. And gold in this environment, physical gold in this environment, looks like a relic of the bygone age, of a bygone century. But I think gold may yet still have its day. So I think people are so obsessed with tradability and liquidity and stuff that can change price quickly on a screen. People have lost touch with the source code of what money really is. I can't remember the person involved, and I think he gets a name check in the book. But it's someone who said that our monetary system, our money now, if you think about what money used to be, it literally was things like gold and probably more usefully silver, obviously because it's cheaper in price. So it was a hard asset. And then the bankers came along and said, well, tell you what, we'll make it easier for you. So we'll hold the gold and silver for you, and you can trade it. You can buy stuff with basically script, with paper that has the value of it on. And you don't need to go to the trouble of taking the gold to market. So you had paper money, and then we don't even have that. So now we just have blips on a screen. And whoever it was, they said, our money now is basically the abstraction of an abstraction. And gold is the exact opposite of that because it's something that's tangible. Mm-hmm. I think that's one reason why it's so misunderstood, because it just isn't trendy right now. But I think it'll start to look a bit trendier when its price as expressed in fiat starts going up, when all other currencies are going through the floor.
Mm-hmm. So you and I were speaking as well before we hit record about the gold miners as well. So how do you look at and evaluate miners and just equities in general that you want to invest in? You and I made the comparison in some ways to Japanese companies at this point and how strong their balance sheets have to be. And we kind of made the parallel into talking about how the gold mining industry as a whole has really had to exert some discipline on itself and clean up their balance sheets over the past, let's say, just decade alone. So are those clean balance sheets, profitability, and expectation of future returns at current or even lower gold prices the keystone pieces that you must have when thinking about investing in some of these equities?
Absolutely. So what we're looking for, and happily technology makes this task relatively easy to perform. So using Bloomberg and using some screening metrics that we look at on a daily basis, we can basically try and identify companies that have the following attributes. Some of those attributes are going to be soft, namely things like quality of management, which is to an extent subjective. Mm-hmm. But a share price history of superior returns can obviously be quite easily identified on a screen. But then in terms of the harder attributes, we will only really consider investing into a business that has little or no debt on the balance sheet. End of story. We will only really consider a business that is generating, extremely attractive cash flow and has a cash flow yield of, let's say, north of 10%. And we want those attributes, whether we're buying a gold mining company or a shoe manufacturer or an auto business. So it doesn't really matter what the sector is. Some of the other metrics are then slightly more negotiable, but they're the kind of things that Ben Graham would also have favored, which is all things being equal on a relatively low price to earnings ratio, relatively low price to book, et cetera, et cetera, et cetera. So you don't want to consciously overpay. The main Benjamin Graham point here is that, to boil the essence of his value approach down to something that can be meaningful to somebody to understand, it's A, don't buy crappy businesses, and B, don't overpay for good businesses. That's it. That's as simple and as complicated as it gets. So, as we like to say, this isn't rocket surgery.
Absolutely. So, Tim, do you think that the rise of cryptocurrencies have taken away some of the attractiveness of gold? I know I've asked this question of many guests, but I'd like to get your take on it and your take on cryptocurrencies in general.
I mean, the honest answer is that I don't know. As a sort of post hoc argument, it seems plausible that, why is gold, let's say, disappointed in an environment where you would expect it to shine in terms of a nascent inflationary surge? I think it's certainly a plausible argument that the reason gold has underperformed relative to what you would have thought, or what expectations would have been, is because crypto's grabbed the limelight. So whether it's Bitcoin or Ethereum or whatever other form of cryptocurrency we're talking about, investors, I suspect, on the margin are driven by the media, and they're driven by column inches and airtime. Well, with some obvious honourable exceptions, a lot of media will not have been reporting on gold, but they will have been reporting on cryptocurrency almost exclusively. And I dare say that every day, even now, you're getting new podcasts up about focusing on the latest type of coin. And meanwhile, gold just has sort of just been there in the background, sort of perhaps somewhat plaintively saying, "Look at me, I haven't gone away." But this is the nature of markets. Things fall in favor, they fall out of favor, they get trendy, they get overlooked. People chase fads. It's just like fashion. So in a sense, again, being a value investor, we should probably be a little bit happier when gold seems to be out of favor, because it means we can buy it more cheaply.
Well, and kind of in that vein, it's interesting to think about that we're 10% off the all-time high today. That's really, when we think about it being quote unquote out of favor, that just demonstrates its stability through times like this, right?
Oh, for sure. I mean, you could make the same argument, which is actually the same argument just in reverse, which is all that we're seeing is a temporary improvement in the fortunes of fiat currency relative to gold. In other words, maybe this is just a somewhat bizarre surge in let's say the dollar versus gold, but it's not a lasting one, because we know that since the Federal Reserve was established in 1913, the US dollar has lost around 98% of its purchasing power, as will happen when in a year like last year, you have a year or a roughly 12-month period where 25% of all the dollars ever printed get printed. Mm-hmm. So with monetary friends like that, who needs enemies?
Yeah, that's a great way to put it. And it's interesting to, when we think about what the value of gold is, sometimes it's very informative and important to think about taking the comparisons and, as you say, kind of turning them on their heads, comparing it to different asset classes to gain some perspective. Obviously, I know I've heard from many gold investors right now that are frustrated. Some of them are throwing in the towel, and I can certainly understand that. But when we step back and look at this time in the grander scheme of history, it seems that we're not necessarily at such a bad place as one would think by the amount of hate in some ways that gold has gotten over the past, let's just say year, for example.
Well, I think you're absolutely right to cite the fact that we're only a relatively modest way off, the recent high. And you compare that to, where gold's been as expressed in dollars since 2000. So we've come from like $250 all the way up to, to shy of 2000. But maybe we're looking through the wrong end of the telescope here. I've been hugely lucky to work with people who've really thought profoundly about the role of gold in portfolios. And one of those is a company called Edelweiss Holdings in Zurich. And one of their directors made the following observation a while back, and I think I've been able to commit it to memory. So here goes. Gold is not even an investment. It is a conscious decision to refrain from investing until the return of an honest monetary system makes a calculation of relative asset prices possible once again. Now, that's a slightly sort of deep, I think it's a genuinely deep observation. Mm-hmm. It speaks to a certain knowledge of exactly what we should be dealing with here, which is, it's like when clients ask us at what price we're going to take profits in gold, say, is the wrong question to be answering. It's altogether more circumstantial than that. So to respond to that question, my answer would be, we will consider disinvesting from our gold-related investments when the conditions that warranted their purchase in the first place have been resolved. Mm-hmm. And one of the primary, if not the main, if exclusively the main reason why we're invested in gold and gold-related things and silver-related things and commodities and commodity-related things, but particularly the precious metals, is one of the reasons we're holding these things is because the debt problem has become completely insurmountable. And at some point, we expect a currency collapse. It does not make any sense to be talking about what is gold worth in dollars if the dollar itself is not worth anything. So, and this is something I've written about in the past ad infinitum. It's like, we know what a kilo is. We know what a kilogram is because it has a strict scientific definition in relation to, it is the mass of a given amount of material of a certain type held at a certain laboratory in north of Paris. And that's what a kilogram is. Mm-hmm. Well, what's a dollar? The answer is nobody knows. And therefore its value is assessed every day on the foreign exchange market. But there's no definition for what a dollar's worth. Well, at least we know what an ounce of gold is, because an ounce of gold is an ounce of gold is an ounce of gold, and it's uniform in space and time. Mm-hmm. So it's fungible, et cetera, et cetera, et cetera. And to continue the thread in relation to the people at Edelweiss, they say, look, if you're trying to price gold using something like the dollar, it's like trying to measure a suit using a piece of elastic. It just can't be done. So the only fair conclusion is you throw away the piece of elastic and find a unit of measurement that can't be distorted at will. Mm-hmm. So I think there is an ultimate timelessness to this stuff, and that because inflation hasn't been much of a problem for the last X decades, a lot of investors have behaved as if it never will be a problem. Well, get a load of what's happening now. Mm-hmm. Inflation is a problem. Deal with it. And so how do we attempt to deal with it? We deal with it by using, not exclusively, because obviously investing in listed businesses as well, but we're getting exposure to the one asset. To go back to the currency debate, it is the one currency that is nobody else's liability. So in that sense, gold is the currency par excellence, surely.
So, Tim, obviously we compare gold to the dollar quite a bit. Do you think that the environment of having a strong dollar is really the only thing that matters when we compare gold, or when we think about the catalysts for a higher gold price? Do you think that we exclusively need, dollar going down equals gold going up, or what other factors do you think will start to propel gold higher?
I think my suspicion is that, I think that the US dollar will be the last fiat currency standing, maybe possibly the Swissy, but my sense is that the gold rally will really take off when gold expressed in all currencies is going up, not just the dollar. So I think it certainly helps the narrative, but not exclusively so. My sense is that for confirmation that we really are back at the races, so to speak, it'll be gold finding new highs in every currency in the world.
Mm-hmm. So can you see a scenario where the dollar and gold are going up at the same time?
Given the market environment right now, I would struggle to see that, because that would in large part be consistent with, in the very short term, possibly as a flight to safety argument. Mm-hmm. Yes, as the dollar being the world's least dirty shirt. But for any extended period of time, I would struggle in this environment to see that, because I would struggle in any environment anytime soon to see the Fed doing what is required and taking the inflationary bull by the horns and actually jacking up rates to the extent that they should be realistically raised. And I don't think that's going to happen. I think it's going to happen in a million years.
Mm-hmm. Yeah, I think that speaks towards the idea that we really have to have a nuanced understanding of kind of the progression of how the currency devaluation and the appreciation of gold will kind of happen, right?
So logically, you'd expect that the gold price would manifest itself higher in the weakest currencies, and then things would ripple in back to the core. But these markets are so strange, and we're not writing anything in or out right now. So we're just trying to keep things on an even keel. Mm-hmm. But we are living through extraordinary times. I mean, you only have to look at interest rates, to remind yourself that.
Mm-hmm. Tim, you shared with me some thoughts contrasting being an investor versus being a trader. So can you share with our audience what you meant by that?
Sure. So I started my career as a bond salesman. So I started my career in a dealing room environment and worked there for basically around 10 years or so. And as someone who wasn't financially trained, so I read English, so I'm an arts graduate, not an economist. As someone who was sort of a bit akin to a fish out of water, at least for the start of my career, I felt like the nature of the dealing room environment was such that you needed to have a view on everything. So that, in other words, the sign of success was someone could ask you, what do you think about dollar yen? And you have an instant answer, I'm buyer at X. Or what do you think about sterling? Or what do you think about Bund yields? Or what do you think about OATs? Or price of zinc? And you were expected to have an answer. And it didn't really matter whether you were right or not, so much as you could just, from a sales perspective, as long as you had a plausible answer to begin with. And I think that's the nature of the sort of the investment culture, that you have a view on everything, and you have a trading view on everything. But it's not likely to be terribly well informed by definition. And so what we were talking about earlier was what I'm used to, what my career progression, such as it has happened, is that I probably started thinking a bit like a trader. In other words, whatever it is, I'll have an answer for you. I'll have a price target for you. And then over time, the penny drops, or at least I think and hope that it dropped for me. Over time, you start to appreciate that actually you don't need a view on everything, because you can't possibly hope to understand anything near everything. So then you start to think more like an investor. And this is the kind of thing that probably Warren Buffett or Charlie Munger would write about. And this is narrowing your zone of competence, if you like. This is narrowing down your focus so that instead of being a jack of all trades, you can just have a more than a passing awareness of a small number of things, but you know them really well. And then I think the absolute pinnacle of this progression is when you transcend even that, and you start to think in the context of the stock market, for example, you start to think like a business owner. And the business owner is only interested in a tiny handful of things. Mm-hmm. And the business owner investor may actually never trade from one day, week, month, or even year to the next, because he knows exactly what he wants, and he's unlikely to want to compromise to get it. And so each time your circle of competencies is getting smaller, but more robust, more defensible intellectually. Mm-hmm. And I think that's certainly the progression that I think has merit. And that's what I would encourage anybody to try and pursue. It may not be to everyone's taste, though, because we're all different. So that's something that I think and hope worked for me. But it's horses for courses. People should do what they are most comfortable with. So the reason Killian and I operate the way we do is because we both want to be able to sleep at night. I would be extremely uncomfortable and would suffer. I would struggle to sleep if we were basically trading our way through this crisis, this predicament.
Mm-hmm. Yeah, it seems that, let's say, the framework that you think about being a business owner investor is really the creation of value by having a sound business model that plays out over, a couple of years, as you said. Is that fair?
I think it's very fair, but it comes down to sort of what do you want out of your investments, and what we're deliberately not trying to do is simply almost randomly trying to shoot the lights out, trying to outperform some kind of index. The thing that it occurred to me relatively early on, it would have been around the first dot-com boom, so around 98, 99, it struck me that it's through a book, Against the Gods, and it was a quote from a guy called Daniel Bernoulli. I warned you earlier that this could become it was in danger of becoming a cheesy quote fest, so let the cheesy quotes commence. Mm-hmm. And there's a quote from Daniel Bernoulli. Now, Against the Gods is a terrific book by Peter Bernstein, and it's a history of risk. It's basically a biography of risk, if you like. Mm-hmm. And one thing leapt from the pages of that book, in my mind, quote from Daniel Bernoulli, who's arguably the world's first behavioral economist, though he was actually a Renaissance man and a physicist and scientist and so on and so forth. And he said, basically, if you're managing money for wealthy people, quote, the practical utility of any gain in portfolio value inversely relates to the size of the portfolio, unquote. In plainer English, if you're managing money for wealthy people, just don't lose it. In other words, what he was saying was our attitudes to capital gain are not the same. The wealthy person, logically, pragmatically, should be more concerned with preserving what he has than with trying to double it. Obviously, everybody wants to make a decent return, but the wealthy person's already got the money to begin with. So he ought logically to think slightly differently about his money than, say, somebody who hasn't got much to begin with, but is interested in doubling it. Mm-hmm. So it changes your risk appetite. It changes your risk preference. And when I came across that changed everything for me, because then you started to appreciate that, well, maybe I shouldn't be benchmarking my portfolios to some arbitrary equity index. Maybe I should be benchmarking them to cash or to inflation or to inflation plus or whatever it is, some form of absolute return. And that was probably the period when the scales started to fall from my eyes. And I started to appreciate that most of the industry is doing everything wrong, which is one driver for writing the book.
Yeah, it's interesting that you kind of mention how the wealthy individual doesn't need to take as much risk. And that kind of goes towards, what we've seen over the past 2 years, where let's just take the millennial and Gen Z generation of investors that are, for lack of a better word, YOLOing what they do have to try and double it or triple it or what have you, because in some of these meme stocks, because, in some ways they have no other way of buying a home, of, being able to afford the things that their parents did. So this has driven insane risk appetite into those types of investors that need to build up something to be able to preserve, right?
I think that's absolutely fair. That a whole generation of putative investors has been disenfranchised by the system. And I would go back to the culprit, the public enemy number one being the central banks. This is no accident that, part of the inevitable impact of monetary policy has been that if you're a young person, well, you're going to struggle to get a job. You're going to struggle with a ton of debt as a student loan. You're going to struggle to get on the housing ladder. And thank you, central banks, because these are the people to blame for that.
So, Tim, I've often asked guests about how they think about or hedge risk in their portfolio, but it sounds like you have a much more, in a way, a holistic way of looking at and having risk appetite, because you're investing in assets that are inherently, I don't want to say risk-free, but able to provide you with a level of risk that lets you sleep at night, right?
I think that's a fair comment. The thing that was probably influential was whether it was coincidental or deliberately influenced by, is probably too long ago now to be able to remember on my part. But so there's a guy called Harry Brown that many of your listeners will probably be familiar with, and he came up with this concept known as the permanent portfolio. This is going back to the 1970s. And the permanent portfolio is basically a quick and clean way of allocating your capital. So you split up your investable pie into 4 quarters. You put 25% in cash, you put 25% in bonds, you put 25% in stocks, and you put 25% in gold. And the beauty of the permanent portfolio back then was that it hedged you against a variety of outcomes. So cash and bonds hedged you, if you like, against deflation. The equity piece and the gold piece, to an extent, hedged you against modest inflation. And basically, whenever one element zigged, the other one was likely to zag. And the permanent portfolio worked really well, not just as a concept, but as an actual investment for 20, 30 years. The problem and this is a problem that's been live for at least the last 10, 15 years, is when cash rates are derisory or zero or negative, and interest rates in the market are the same, Harry Brand's permanent portfolio doesn't work anymore. So what we've tried to find is effectively a modern equivalent of the permanent portfolio that can try and weather us through as many different types of storms as possible. And that's ultimately how we came to the mix that we've got now, which, regardless of the percentage allocations, basically comes down to value stocks, quality businesses, but value stocks plus trend following funds, uncorrelated, price momentum approaches plus real assets. And the good thing about this, it's not to say it's perfect, but the attractive thing about this approach is that we can be more or less fully invested for our clients and for our own portfolios without having to worry about market timing, because there are so many risks out there that you don't appreciate until after the fact. One of them is that the idea of market. Firstly, I can't market time for toffee, and secondly, it may seem after the fact that you've done the right thing by being out of the stock market. That could seem like a very sensible conclusion to come to sometime this year, because the market looks like it's about to shake itself to pieces. But the problem that you have when you come out of the market is, when on earth do you go back in? If we take recent experience, the secular opportunity to get back into stocks was March 2009. Well, as an asset manager at the time, I can tell you that March 2009 felt like the end of the world. So market timing is easy to talk about, but it's hellishly difficult to execute in the real world. So the beauty of this like tripartite approach that we're currently using is that you don't have to worry about market timing, because you're always in pockets of assets that you consider broadly defensive, sensible, yieldy to a certain extent. You don't have to worry about the market timing issue at all. Mm-hmm. And so that's really what it comes down to. I stress this point. I can't stress it highly enough. I think you need to know yourself as an investor. And there's another cheesy quote warning. If someone said, if you don't know who you are, the stock market is an expensive place to find out.
Yeah, that's a great way to find that out. And it's interesting that you're talking about March of 2009. It seems like if we really want to talk about market timing, we could say towards the end of March of preceding a dramatic crash would be a good time to get in the market, and or when the Fed reverses course, drops rates, and does whatever they can, right?
I mean, all I can say is it seems to me that this is going to be a tricky year, but suffice to say, both Killian and I have no trouble sleeping. That's not to say we're overconfident. That's not to say we expect to breeze through this predicament that we're currently faced with. Mm-hmm. But there is a plausible thesis behind everything that we own. And not just a plausible thesis, but solid valuations and the kind of attributes that people like Ben Graham have always focused on. You have to invest in something, and we prefer to invest in maths rather than magic.
Mm-hmm. Well, Tim, I think that's a great place to kind of wrap up our conversation for today. I thank you for sharing your cheesy quotes and your perspective with us. Of course, you write a fairly frequent commentary on what's going on at pricevaluepartners.com, and you're quite active on Twitter as well, at Tim F. Price. Is there anywhere else you'd like to point towards?
No, those are the usual suspects. So I'd be delighted if people want to engage with me there.
Excellent. Tim, thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.